All right. Well, thank you everyone for joining us today. My name is Stephen Schaefer. I'm a senior retirement plan consultant with Primark Benefits. We'll be discussing CalSavers retirement program and how you may provide a better solution for both employees and employers. Joining me today will be Stephen DeBro, president of Primark Benefits. Stephen has been leading Primark Benefits since 1990, is an expert in converting tax dollars into employee benefits. He holds a degree in management from Golden Gate University and holds many pension industry professional designations. He serves as past president of the American Society of Pension Professionals and Actuaries and was formerly a special director of the American Academy of Actuaries. Stephen is very active in Washington, D.C., meeting with senators, congresspeople, staffers, and officials of the IRS, Treasury, and Department of Labor to promote pension policy for American workers. He is called upon to give testimony to Congress and to regulatory agencies. Stephen, thank you for joining us today.
Thank you so much, Stephen, and welcome everyone. I'd like to talk to you for a second here about Primark Benefits. We're entering our 50th year of business, and I've worked there since 1976. We have about 700 clients, mostly in the San Francisco Bay Area, but spread throughout the country. We have 33 employees and a really deep knowledge base within our staff. We're committed to personalized client service, and we're a lot more than an 800 number. When you actually call us, we want to talk to you and dig down and find out the real question so we can give you the right answer the first time. And that's what we feel that customer service is all about. So today we're going to be talking about the mandate. The mandate is from the state of California and other states to dictate to employers that they will offer retirement programs to their employees. And it turns out that this is in reaction to the fact that there is a retirement crisis in this country. And we're going to talk about that in a minute. But CalSavers is one of the solutions that has been come up with to help solve that retirement crisis. But the CalSavers program isn't perfect and isn't for everyone. And so we thought we'd explore what are some of the other options you can do so you can have a really great program that's going to benefit all of your employees in a way you want to benefit them, and actually create a realistic retirement program so that everyone can actually build a nest egg and save some money and feel better about having a retirement income later on. One size doesn't really fit anybody, so we're going to show you some of the things that you can do aside from that. So first of all, the most successful retirement plan in the United States is the 401k plan. You can't go on the internet or pick up a book or magazine without reading something about 401k. It turns out that when workers are covered by a 401k plan, people from all walks of life, from all levels of the organization participate. And there is something that goes around once in a while that says 401k is for rich people. Well, that's not true. 401k is for the average American worker. 60 million American workers are covered by a 403b or a 401k or 457 or one of those kinds of plans where they take money out of their check every payday and send it off into an investment, which usually goes into the stock market in the form of a mutual fund. So the American workers are actually contributing lots of money every payday, and it keeps the stock market afloat even during bad times. And you will see that it's not just rich people or people making 200,000 or more that get into a 401k plan. It's really populated by the people with salaries less than that. And how important is a 401k plan to our society? Well, the single most determinant factor on whether anyone has a retirement account is, are they offered a plan at work? If they are offered a plan at work, 71% of them will end up with a retirement account. If they're not offered by a plan at work and go off on their own to create an IRA, only 4.6% of Americans will actually create that IRA. So what we have found is 401k plan is the thing that works, or it's part of the problems to solving the retirement crisis. The importance of a 401k plan, we know that all the liquid money in America seems to be in people's retirement accounts. Yes, people have a house. Yes, they have a retirement account, but there's a misnomer that everyone thinks that you have a large amount of savings and that kind of thing. Well, we find out when people get divorced, the only two things they have to split up are the 401k plan and their house. And so really, we've really come into the thing, especially during pandemic times, where the only source of money for folks are their retirement accounts. So, in answer to this, many states, first the federal government, and then many states decided to get involved in this. So states have taken the thing on their own. There's 12 states and one city which have actually started a program to create a retirement savings program where employees are automatically enrolled and take money out of their paychecks every payday and send it off to an IRA type plan. And there are many efforts in many other states throughout the country to go ahead and start this kind of program. The first one to start was Oregon, and we're going to talk about Oregon Saves. And then the second one was California Saves, and Illinois, and third was Illinois Savings Program. And they all have similar kind of characteristics. Other cities and other states have started on this path. Some are creating a marketplace of retirement plans where you can get an actual 401k plan, but most are just going with this IRA idea. So the federal government has tried to solve this problem in a number of ways. First of all, they keep expanding the number of retirement plans that are available. I like to tell people, you've heard of an IRA, you've heard of a 401k. That's just one of 24 different types of retirement plans that you can have at a small employer. So the federal government has put in some incentives, like, for example, if you don't have a plan now and you come to Primark Benefits, the federal government will pay in the form of a tax credit to you, the employer, 50% of our fees, up to $5,000 a year for the first 3 years. So the government has said, well, the people that think it's too expensive to get a retirement plan, let's go ahead and give a tax credit. Also, they came out with more and more programs so that, if you had a complaint about you have to file a tax form and be a fiduciary. Well, we have another IRA-based program called a SEP, or one called a Simple, where you can put the money in IRAs and not file a federal tax form for the plan. So the federal government has done everything that they can to make pensions more affordable and more accessible for folks. The government actually tried an IRA-based program called MIRA for a few years during the Obama administration. That wasn't a mandate, so it really didn't last, and it went away. States have started to mandate these programs, as we mentioned. California is one of them, and a local like Seattle and New York City, started programs, but the Trump administration blocked it, and it remains to be seen what they're going to do now. So the first success story was Oregon Saves. They've been over 3 years. They have 58 million in retirement, and they view it as a big success. In fact, they got on the road and they said, okay, this is so great and it's working so well. Any other states out there, if you're trying to do this, you don't have to do anything. You can join Oregon Saves and have your employer send all your money to Oregon Saves, and we'll do all the work for you. And then they said, hey, if you're a gig driver with Uber or Uber Eats or one of these Lyft people, come on in here, enroll yourself, and we'll set up a Oregon Saves account for you as a self-employed person. And so at last count, 70,000 workers of 4,300 employers are in the program. And of those folks, we have about a 30% opt-out rate. 71% of the people who are eligible have not opted out of Oregon Saves. So we found out some stuff when Oregon Saves went on and got the first one. The first thing we found out is that it takes a long time for workers to get out of the pipeline because the investment provider needs to talk to their customers, so to speak, and so the state needs to hire someone to call you. So the pipeline gets really long. We also found out that the majority of people in the Oregon Saves program are in food service, agriculture, temporary labor, the high turnover kind of positions, mostly minimum wage type jobs. I guess that more employers of big, large corporations, they have 401k plans and other retirement plans, which means they wouldn't be eligible for Oregon Saves. We find out that 10,000 savers out of the plan, this was the last number I had worked for more than one of these folks. So these minimum wage or construction workers or restaurant workers keep jumping from job to job to job, and they get money sent in from multiple employers. In Oregon, if you don't sign up your company into Oregon Saves, there is a fine of up to $5,000 per year. So California, not to be outdone, we actually passed the law first, but because we were refining the way it worked, Oregon started first. We have 739,000 employers who do not provide a retirement plan to their employees, and about 4 million full-time employees and 2.1 million part-time employees have no access to a retirement plan at work. And so state of California comes to the rescue. Okay, we're going to start CalSavers. Yes, the organization that brought you Caltrans and DMV is now in the retirement business. So what is CalSavers? Well, back in 2016, the state Senate passed Bill 1234, which had them offer CalSavers. They contracted with a private company called Census and another private company called State Street Bank in order to put the program together. This program was supposed to take all the fiduciary responsibilities off the table of the employer and make it be so that it was easy to set up the plan. And employers with 5 or more employees who do not provide a retirement plan or already have one would have to register with CalSavers and start enrolling their employees by a year from June, or else there's fines. So some employers are excluded from the mandate. And if you already have a retirement plan, you don't have to do CalSavers. In fact, if you already have a retirement plan of any kind, you can't do CalSavers. Okay, so one of the exempt groups are any employer with 5 or more employees. And please keep in mind that husband and wife business, that kind of thing, where they're the owners and they're working in the business, they count as employees if they have a Schedule C or a partnership return and they show earned income. So that 5 might include the boss or the owner. And if you're a group of companies where you're related to each other and one of those members has a retirement plan, then you're not allowed to go to CalSavers. You wouldn't be eligible for that. If you're a member of an affiliated service group, like for example, if you're a medical practice that's affiliated with other medical practices and one of those practices has a 401k or some other retirement plan, then CalSavers would be an exclusion for you. You wouldn't be able to get in it. If you're a government, you're not subject to the mandate. And then certain religious organizations are, the churches and stuff, they don't have to have a CalSavers program. So one of the deadlines has already passed, September 30th, 2020, was the date for all employers with 100 or more employees to register for CalSavers. And many of them did. A lot of them received an email. Maybe you've heard about this, where CalSavers says, "Hey, we haven't heard from you. You have to enroll your employees and sign up for CalSavers. Please go to our website and click and give us your information." And one of the buttons there was kind of hidden, but it really said, "Hey, I already have a retirement plan. I'm not eligible for CalSavers. I won't be joining." And they just want you to let them know. They tried their best to screen out the people they already knew had other retirement plans, but we got a lot of our clients came and said, "What do I have to do with this?" Well, just go there and click that you're not eligible and tell them who you are. In any case, this June, those employers that have between 50 and 100 employees will have to register or opt out if they're eligible to opt out. And then by June 30th, 2022, all employers with more than 5 employees will be required to have CalSavers. So how does this thing work? Well, what happens is that the money comes off your paycheck after tax and through whatever payroll processing that employer has, and goes off to an investment pool that's made up of IRAs for the employees. So contributions to the savers account will occur automatically through each paycheck. And they're gonna start you off at 5%, and then there's going to be an automatic increase every year. So next year, your employee that started at 5 is going to be 6, and it's going to go 7, 8, and finally reaches 8%, and then it'll stop adjusting upwards. So someone with 3 years who doesn't opt out, they're going to find themselves taking 8% of compensation and sending it over to an IRA. The IRA it goes to is called a Roth IRA. And it's an after-tax IRA, so there is no tax break involved with CalSavers, other than a tax break you might get on the earnings, because the earnings may never be taxed if everything happens correctly in a Roth IRA. And the first $1,000 of contributions will be invested in the CalSavers money market fund. So that really means that the first $1,000 in today's environment will not earn any interest. So it just have to build up the first $1,000. After you get over that hump, you will then be put into target date retirement funds from State Street Bank. And these target date funds are not bad. They're very comparable to the Vanguard series of target date funds. And what a target date fund is where the managers of the fund, they keep in mind how old you are. And then they say, well, how much risk can this person take between now and the time they retire? And the closer they get to retirement, the less risk they have in the portfolio. In other words, the closer you get to the date listed in the target date retirement it comes to, like 2040 or 2050, that's the date when it stops adjusting downward on risk. So you might start off with, say, a target date fund that's 90% in stocks, and then by the time you reach retirement in 2070, it'll be 50% in stocks. So it'll ratably go down every year because that would allow for fewer ups and downs in the portfolio. So target date funds are good. We find that participants in target date funds have earned 8, 9, 10, 12% per year over the last decade. And it's been very exciting to the participants that we service because they've been having to do no work and worry about their portfolio. The managers take care of it and they get great returns. Now, employees can customize their own account and choose alternative savings within the list of funds that they have. Once you get more than $1,000 in there, you get the target date fund, or maybe you're a socially responsible investor and want to choose the socially responsible fund. So the investments are not that bad. They perform well, and their cost is low. The asset-based fee is less than 1%. And for someone starting out with a small plan, that's a very, very competitive fee schedule. So an eligible employer is responsible for doing some work. It's not that they don't do any. A lot of them will lean on their payroll company to help provide this information, but the employer needs to make out a roster of everyone's name, date of birth, social security number, and contact information so that payroll can be facilitated and they can talk to that participant and talk to them about their investments or answer their questions. Covered employees are automatically enrolled and the state will contact them directly. And the employer has to allow the possibility of those folks opting out. And they can go to zero at any time, or they can reduce their contribution rate to something less than 5% if they want. Now, those employers that don't sign up for CalSavers, I haven't heard of any getting fined at this point, but in the law, there is a penalty of $250 per eligible employee if the state finds that you're not in compliance with the law, and an additional $500 penalty if you don't act when the state says, hey, we caught you and you need to get enrolled. Again, the money gets deposited in after-tax IRAs called Roth IRAs. So all IRAs across the board have one person can put up to $6,000 per year in an IRA, but if they're old like me, over age 50, they get to put $7,000 in this, and that's in all IRAs when all totaled. If you don't qualify for Roth IRA, don't forget that Roth IRA is something special. It's a kind of IRA where the money goes in after tax and it sits there and it grows until you actually spend it, and then it never gets taxed ever again according to the Roth rules. And in fact, it doesn't even get taxed for estate tax purposes when it passes to your children or other heirs. So the Roth IRA is after tax, and the only people that qualify to have Roth IRAs are couples that make less than $207,000 or single people that make a less than $138,500. So if your employer goes ahead and enrolls you in a Roth IRA, there may be a problem because let's say you're married to someone who has a high income. Let's say the family income is more than 207. Well, you have to remove all that money from Roth IRA before the next year's tax filing, so that you can get it out of there because you're not eligible for it. And if you don't, there's a penalty involved. And the IRS, believe me, they know who has IRAs, they know who isn't supposed to, and they will catch you if you do this. Now, in a Roth IRA, you can withdraw the contributions tax-free at any time for any reason. You can withdraw the earnings too on a Roth IRA, but it may trigger taxes and penalties if you do, like if you're under age 59 and a half, and the money hasn't been in a Roth IRA for more than 5 years. Now, this whole thing about CalSavers sending money off to IRAs and enrolling you automatically, the Howard Jarvis Taxpayers Association filed suit against the state of California, and so far they've lost in court 2 times. But there is a law called ERISA, which says how you're supposed to run employer pension plans. It's got a lot of rules in it, and it's one of the things that the state of California is trying to get around. There is something in the tax code that allows employers to set up an IRA savings program, and that's what CalSavers is based on. But in that program, the employer was just supposed to be cashiering. They weren't supposed to be enrolling anybody or opting anybody out or sending the money to one specific place. They were supposed to take directions from their employees to say, where do you want me to mail your IRA check? And so CalSavers jumps on that part of tax code and uses it and says ERISA doesn't apply. And so far, CalSavers has really done a great job of avoiding liability for ERISA. So where do we stand with CalSavers? Well, so far, last numbers I got, there was $30 million invested at CalSavers. They have 100,000 accounts so far. So they have a lot of catch up to do on getting to that 4 million employees that they need to enroll. So far, even though they put in 30 million, 3 million has come back out of the program after it was contributed. The average monthly contribution is $114 per employee. And the average funding account right now has $300 in it. So if an average account has $300, then it's only in the money market. And so therefore today it's earning like pennies, fractions of a penny of interest. 30% of employees are generally opting out. They're saying, oh yeah, I see this money coming out of a check. Can I please stop it? And 7,300 employers so far have registered. So we have a real long way to go on getting everybody, up to speed, or at least, getting those that don't already have plans up to speed. So really, from our point of view, is CalSavers a good idea? The federal government has done, as I said, many things to make plans be more attractive. They have IRA-based programs and 401k-based programs and pension-based programs and governmental programs, church programs, many, many different choices that allow for a little bit of money to a whole lot of money. We have some employers that are sheltering hundreds of thousands of dollars a year for themselves from taxation so that they can build that nest egg. Right now with CalSavers, it's a very low amount of money coming in, and the amounts can end up being minuscule. And, if someone starts out at age 18 and defers 5% into a retirement program their whole career and never takes it out, yeah, that's an adequate retirement. But someone who's starting out midlife and does 5%, they're not going to build an adequate retirement, especially if the money doesn't stay there. There's no way in CalSavers for an employer to put in money as an employer contribution. There can't be a match. There can't be a profit sharing. There can't be an employer IRA contribution. So this is just employee money. And if you're starting late in life, it might be a false sense of adequacy. Now, remember what I said about if you start a retirement plan with Primark benefits and you didn't have one, you get the tax break for 3 years, the tax credit. The government's going to pay for half. That doesn't apply to CalSavers. And then in CalSavers, you're very restricted. You have to put everybody in it. You have to honor roll everybody. There's no ability to pick and choose participants other than they can opt out themselves. Now, the fact that their money's going off into Roth IRAs creates several problems for folks. Let's say you get a W-2 and you run down your CPA. You're an average worker and you've been enrolled in CalSavers. There's nothing on the W-2 that says you've been enrolled in CalSavers. So your CPA says, I know how you can cut your taxes, just like last year. Why don't you go put $6,000 a year into your IRA, this year into your IRA? And when they do that, they don't realize that you already have several thousands of dollars in it from work. And so now you've over-contributed, and now you're going to be put in this government penalty position. The next thing is that CalSavers and the employers are really relying on their payroll providers to make all this right. Now, I don't know how many payrolls you've seen, but we see a lot of payrolls from a lot of different companies, and and they're not always 100% correct. And the level of quality review is left to the employer and whatever the employer's means are for doing that quality review. So this is all relying on the payroll company to get it right, when the payroll company's relying on the employer to get it right. So we don't really know how this is going to work. We know that we have to scrub payrolls for our clients all the time. So that's one thing that might not be such a great idea. Not having a professional looking over the program is really a downfall. Now, there are unknown fees and costs. The way this contract was set up, the state of California was going to compensate the investment advisors by having all this money flow into the target date funds. Well, if the average account is way south of $1,000 a year, no one's putting there any money to speak of into those target date funds. So how are those managers going to get paid? Maybe they'll go back to the state. They've already gotten a big grant from and get more money. In ERISA, you as the employer are protected if you follow the program from being sued. CalSavers doesn't have that protection. Your employees that wake up one day and say, wait a minute, I didn't tell you to take money out of my account, they can sue you for it. And then you're saying, well, I was required to. You're in court making your arguments. There's also a problem, like let's say you have employees throughout the country, you're required, but California payroll, you're required to cover all those employees and withdraw from their check. But now you've got a remote employee working in, say, Massachusetts. You can't do this automatic enrollment from CalSavers. You have to get the participant's permission, or else you've committed a crime in Massachusetts. So there's murky compliance with these other laws. You have a big problem, and it remains to be seen how the state is going to talk to 2 million new participants who all have itty bitty account balances. I don't know where they're going to get the money to be able to hire the people to talk to them. So wouldn't it be better if everybody had something else they could do? Wouldn't it be better if the employer could speak to a provider like Primark Benefits that could explain about the 24 different types of retirement plans that might be appropriate for that employer and their workforce and their situation and their cash flow and their size of their company? They would be able to install the right plan for the right company at the right time, and also get an investment advisor, a professional investment advisor, who can sit down with the employees and talk to them about their financial goals and the best way to meet them, and explain the risk return relationship of all the target date funds or other funds that are going to be offered. And that's a critical part of any savings program, is having some sound advice. There's also problems that can creep up from the employer, and by having a third-party administrator or someone that's a professional walking the employer through all the steps, the employer will not make mistakes. So we could keep the employer out of trouble and enhance the future retirement benefit for all the employees, so they're getting some appreciation of what their account is building to, and their employer is helping them along the way. And so this just allows everyone to focus on better outcomes than just willy-nilly, let's make Roth IRAs. So the common requests of employers that we see, they come to us, they say, well, we need a professional, we need a third-party administrator, we need pension consultants to help us decide what to do and then how to do it, and then guide us in that process. We need someone that's going to sit with our employees and help us choose mutual funds that are going to be the right thing to invest in. We also don't want to be stuck with one financial advisor that we've never heard of. Perhaps we want to go to Schwab or Fidelity or TD Ameritrade or one of the 20 some odd insurance companies that offer 401k programs. Having a choice is always good, so they can compete with each other and give you great service at the lowest possible price. You want to have a plan that is a recruitment and retention tool for your employees. You want to have an opportunity to build a reasonable retirement plan. If someone starts out mid-career, $6,000 a year is not adequate retirement savings. They need to put in more, or get their employer to put in more. And so employers look for us for ways to do that and to build that next nest egg and to catch up if they haven't been contributing. I can't tell you how many people come into our office and say, gosh, I forgot to save for my retirement and I'm 55 years old. What do I do now? Well, you can kind of catch up. So you might as well try with a real retirement plan. You can't do that with CalSavers. And then businesses are subject to cash flow and economic swings. So you don't want to be stuck with the same contribution every year, or you want to take advantage of years where cash flow is good and then put in nothing or little when the cash flow isn't good. You want to take care of your most valuable staff, your executives, your other managers, and you want to select who is who's going to benefit on the plan and by how much, because you can have different contributions for different people. And most employers that come to us, they ask us to have that. They ask us to help their employees have a quality retirement, no matter where they are on the employment scale and the managerial scale. So, CalSavers is a good start. It's a great thing. It's meant well. And for many employers, it is kind of the light bulb that's going to flash. For many employees, it's the light bulb that's going to flash. We think we support the whole idea of CalSavers, but it's just a start. For all of you that are interested in talking to us about having a better retirement plan, or one that is more flexible, or one that does all those things that I mentioned before, we're here to help you. You can reach out to Stephen or myself or anyone from Primark Benefits, and we will be glad to talk you through CalSavers, as well as the other 24 different types of retirement plans that you can have. Please call us today. Thank you so much for attending today.
Thank you, Stephen, for really great information and helping us understand the program and what there is. I also want to take a moment to thank all those in attendance for your time, and for more information to how to make your company's plan work the best for everyone, please reach out to us at retirewell@primarkbenefits.com. Thank you again for attending, and I wish everyone a good afternoon.